Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Strive, Inc., AST.
And we have some pretty incredible source material. Q3 financials from November 2025, details on a massive acquisition, and some very complex financing documents.
This is a company in the middle of an extreme transformation. I mean, the central conflict here is clear. Strive is executing a radical pivot to a highly leveraged Bitcoin treasury with the sole mission to outperform Bitcoin.
And that's their hurdle rate, right? They have to beat Bitcoin to justify this whole thing, despite a crippling 12-20% SATA cost of capital and that huge $192.3 million GAAP loss from the reverse merger.
It's an incredibly high-stakes bet on financial engineering.
Absolutely. So let's start with the basics. What is Strive today?
Right. What is this new identity?
Well, they're billing themselves as the first publicly traded asset management Bitcoin treasury company.
And there's a philosophy behind that. It's not just a financial move.
Exactly. It's a dual mandate. The financial goal is obvious. Grow the corporate Bitcoin treasury aggressively. But it's also ideological. They're sticking with that original anti-ESG focus.
The unapologetic capitalism line.
That's the one. Shareholder primacy, above all else. Every single decision has to serve that mission.
So they have this hybrid model. They haven't completely abandoned their old business.
No, and that's key. The legacy asset management side is kind of the stable foundation. It's got over $2 billion in AUM across, I think, 13 ETFs and trusts.
And that part is profitable.
Just about. Projections for 2026 are basically break-even. Maybe a few million in profit, maybe a small loss. It's not the growth driver, it's the anchor.
So if you're an investor looking for growth, you're not looking at the AUM, you're looking at the corporate treasury.
That's the rocket fuel, or at least that's the plan.
And how does that part actually work?
It's a structured finance model. So they're issuing these complex Bitcoin-backed yield products. The whole idea is to use leverage to capture any Bitcoin appreciation above their own financing costs.
Which are very high. We'll get to that.
Extremely high. It means the whole model requires one thing.
Bitcoin has to go up a lot.
And consistently. If Bitcoin trades sideways, this structure is in serious trouble because that cost of capital just keeps ticking.
Okay, so this is where it gets really interesting. The goal isn't just to hold Bitcoin, it's to increase Bitcoin per share. How are they scaling up so fast?
This is what they call their alpha strategy. And it's basically accretive M&A. They want to be the big consolidator in this space.
And the prime example of that is the Semler Scientific acquisition, SMLR.
Right. That deal was a major signal. The sources say it's going to boost their total holdings to over 10,900 BTC instantly.
But the price they paid was staggering.
It was. The whole deal was structured to be accretive in Bitcoin per share terms. And to do that, they paid a 210% premium in fiat over SMLR's closing price before the announcement.
A 210% premium. What does that tell you about how management thinks?
It tells you they see fiat volatility as just noise. They are optimizing for one thing and one thing only. Stack more Bitcoin on the balance sheet.
Even if it looks crazy from a dollar perspective in the short term.
Exactly. The asset is the goal, not the currency you measure it with. Scale is everything.
But Semler wasn't just a pile of Bitcoin. It had a real profitable medical diagnostics business. What happens to that?
That's seen as non-core. The plan, they say, is to maybe expand it a bit first, turn it into some kind of preventative healthcare platform,
And then
sell it or spin it off, get rid of it.
they're going to dump a profitable business. Why would they do that?
Because it doesn't meet their Bitcoin hurdle rate. It's that simple and that stark.
So if a part of the business isn't directly helping them stack more Bitcoin, it's gone?
It's considered inefficient capital. It has to be replaced by a pure Bitcoin treasury operation. It's incredibly disciplined. You have to give them that.
Which brings us to the engine behind all this, the financial engineering. This alpha strategy needs a ton of leverage.
It does. And to fund it without diluting common shareholders right away, they issued a special kind of security.
The SATA.
The SATA Variable Rate Series, a perpetual preferred stock. Yes. The IPO for that in November 2025 raised about $149.3 million in net proceeds.
And that all goes toward corporate purposes.
Which, means buying more Bitcoin.
Okay, but the fine print on these preferred stocks is always where the risk is. What's the drag here?
This is the absolute core risk of the entire thesis. The SATA carries an extremely high, and the keyword is non-discretionary dividend rate. It starts at 12.00%.
12%. That's junk bond territory.
It's a massive risk premium the market is demanding. It tells you how risky this is perceived to be.
And gets worse if they can't pay.
Oh, much worse. It's a ticking time bomb. If they miss a dividend payment, it compounds monthly. And the rate itself starts climbing by 25 basis points every single month.
Up to what?
Up to a maximum rate of 20% per year. That's the crippling cost of capital baked into the structure. They have to earn more than 12% on their assets just to stand still.
Wow. But they have access to more capital than just that initial offering, right?
Oh, yeah. They've lined up a lot of dry powder. The documents show up to $1.5 billion in potential funding.
And how is that broken down?
It's split. About $750 million was raised through a PIPE deal, and there's another potential $750 million if the warrants from that deal get exercised.
Plus, they have an ATM program.
Correct, a $450 million at-the-market common equity program. So they have flexibility to raise cash. The capacity is there. The cost of that capacity is the problem.
So let's look at the immediate financial health. The Q3 numbers, right after the merger, they looked rough.
They did. For that very short period, just September 12th to the 30th, the headline GAAP net loss was $192.3 million.
That's a shocking number for just 18 days.
It is, but you have to dig into it. The vast majority of that, about $141 million, was a non-cash charge.
For what?
Goodwill impairment. Basically an accounting write-down from cleaning up the reverse merger. So it's a painful paper loss, but it's cleanup.
So what was the actual adjusted loss?
The non-GAAP adjusted loss was a more reasonable $13.0 million. Still a loss. But it shows the complexity of what they're trying to pull off here.
Okay, so long term, what's the core risk? It all comes back to that cost of capital versus the asset.
Exactly. The structural weakness is that 12 to 20% cost. It means Bitcoin doesn't just have to go up. It has to go up dramatically and consistently.
It has to outperform that rate just for them to break even.
Just to justify the debt. If Bitcoin's annual return is less than 12%, they're structurally bleeding money and that dividend escalator kicks in. It's a brutal setup.
And this is why they're chasing scale so hard. Why that specific target of a $5 to $6 billion market cap?
That's not a random number. It's all about getting institutional money.
Explain that.
That $5 to $6 billion level is the threshold where massive capital pools, like pension funds or sovereign wealth funds, can even start to look at you.
They have minimum size requirements.
Right, or concentration limits. Strive has to get big enough to even show up on the radar of the really big, slow-moving money. It's a strategic necessity.
So let's synthesize this. The investment case is a high-octane bet. Does the alpha strategy, grabbing 10,900 BTC and using superior leverage, justify this as a kind of amplified Bitcoin play?
That's the bull case. The counter-argument, though, is that non-negotiable 12 to 20% dividend. It's a guillotine hanging over the whole structure.
So it's not just a bet on Bitcoin.
Not at all. It's a bet on their financial engineering working perfectly in a bull market. There is zero margin for error.
And it's interesting they're fighting this battle on another front, too, with the index providers.
Right. They're actively lobbying against that proposed MSCI rule that would exclude companies if digital assets are more than 50% of their total assets.
And their argument is
that it's an arbitrary rule that unfairly targets Bitcoin companies and violates the principle of index neutrality. They're fighting to keep the institutional gates open for companies exactly like them.
So here's the long game to think about. If this whole model depends on institutional capital needing a vehicle to chase Bitcoin's gains, does Strive's really complex, high-speed financial engineering represent the only way to win that Bitcoin Treasury gold rush?
Or is it maybe a sign of desperation? A race against the clock before that 12% dividend starts compounding toward 20% and eats them alive?
Something critical for you to consider as you review the documents: risk defined, portfolio protected.